Hi and welcome to this week's Earnings Digest, where as usual we'll take a look at main earnings happening next week and discuss a volatility use case from an options trading perspective. And actually this week let's talk about some popular subject that we somehow see quite often in social media, etc., around a classic strategy, somehow a beginner or first step strategy into trading, and which revolves around covered calls, especially how to work with them with upcoming earnings, right? So whether you're used to selling these covered calls, or by the way, symmetrically the same would apply for cash secured puts. So this confusion and this sort of challenge that comes with an upcoming earnings. And so, for example, this week we've seen one of the big moves, classic big moves on earnings happen with Palantir Technology earlier this week. And so a huge move, basically more than a 12-13% rise, hitting around $30 price. And so basically a lot of people who are used to selling calls for these stocks or other ones will challenge and see these upcoming challenges with these potential big moves, and somewhat can find themselves in bad situations. So let's see why exactly does that happen, how we can basically fix it, and perhaps play earnings in a smarter way. And so for that, let's actually do a use case with an upcoming earnings for next week here. So let's look at Walmart with upcoming earnings Thursday before market open. So the first day of trading after release is Thursday, basically. Now let's actually go ahead and simulate some type of these classic positions, these covered calls. And so here we use our simulator from the Earnings Watcher platform. And really the specificity, what we need here is this taking into account this phenomenon that happens around earnings called IV crush. So let's illustrate that quickly by actually looking at this default position that was composed. So basically this closest expiration call, 69 strike. Notice the last stock price at around 67. So we see here is classic price, delta and gamma. Notice that first of all, the price of this option today, currently a week before earnings, will actually be higher than the usual price of this type of delta or this type of call in a different day outside of earnings. Why? This is because of the phenomenon known as IV rush, then IV crush that happens around earnings. And so basically IV for these options will steadily rise in the weeks or days leading to earnings. So here leading to Thursday basically. And then on Thursday, so the first day of trading after release, we see this IV crush. As you can see here, for example, for this call, the IV is expected to drop from 42 currently to around 25 basically on Thursday. This dynamic, this famous dynamic of IV crush, is basically, you can think of it as the way the market is pricing in the upcoming earnings move. Why? Well, obviously the market is aware that stocks move around earnings, and so here quickly we can see the breakdown of Walmart past moves. Obviously, so a last move of 5.2%, 2.9, 8.4, 2.7. So there are substantial moves that happen on earning, and obviously there's no free lunch, so the market accounts for that with this phenomenon of IV crush. In concrete terms, what does that mean? It means that basically the break even of the position, what we call the implied move, this is basically the amount of move in percentage of the stock move where the position will be profitable, whatever position we're talking about. So here we're talking about this sort of close at the money call for Walmart. We see the calculation that we basically done here for you is that taking into account that IV crush and theta decay and all the other factors playing in the option pricing, well, this is our implied move. This is our break even, 3.3% on the upward side, meaning that basically we are safe until unless the move goes above that 3.3%. Now here what we want is to simulate the short side. So what we're doing is selling this call. So let's go ahead and basically compose the same position, and let's actually perhaps go further out of the money and simulate selling basically this 70 strike call. So we see here that the premium associated will be 0.82 basically dollar per contract. Obviously, this is the symmetric of the long position. This is what selling a covered call would be. And so here we find back our usual break even, dismiss this small negative value, but basically we see that if the stock move is under this 3.6%, we would be safe. And so you see in this price simulation how basically going through the week for a scenario of no stock move at all, and this is basically the best case scenario we can hope for earnings of and doing these type of strategies, and nothing happens basically as we go through earnings. Well, basically what we sold for, as you see here, 82 cents per contract, well, we can buy it back on Thursday with, as you can see here, a very negligible price, basically $0. And so this contract, this call, would have seen its value drop by basically 98%, which is sort of expected because this is an out of the money call. And given this, obviously, plus this huge IV crush that happens, if the move basically does not exceed this implied move, well, we are profitable and we can buy back our call and basically profit from this big premium that we obtained. However, obviously, you see the risk with the scenario is that let's see what happens when if something like with Palantir stock earlier this week happens and the stock basically moves in an upward move. First of all, obviously, a downward move would be even better for us. But let's see the kind of P&L we would expect from the wrong scenario basically happening, and something like with the Palantir earlier this week. We see as we move the sliders here down under the slide, the P&L and the loss gets heavier and heavier as the stock basically moves up. So here, as an example, you see for a stock price of $71, well, the P&L is already at minus 141, so even bigger than basically here. What it means is that what we sold for 0.82, well, now we have to buy it for 1.98, right? So actually putting in more money than what we even obtained. And this is the classic risk coming with the short straddle, calls or puts, short positions. Obviously here it would be covered, so the trader has the stock and can obviously deliver on these stocks, but here you can see it as the what you're missing out basically from selling those stocks early and having them assigned. If this was a short position, basically you see as the stock moves, one of these, say, worst case scenarios. Let's go ahead and simulate a big move. So for example, 16%. You see the loss basically gets deeper and deeper with minus even more than 1,000% here. And as we move forward, for example, a maximum of 30%, we arrive at this huge number of basically the streamroller effect, where the position, as expected now, the 70 the strike call is deep at the money, and so we get assigned and we have to buy it back with this price basically, while we bought it for, we sold it for a much cheaper price. Now, okay, this is the challenge. This is the type of risk we are facing doing this type of calls, basically short calls going through earnings. Let's see how we can fix it. And so first thing here that we can do is that rather than having this short call by itself going through earnings, let's actually cover it by going ahead and buying a call that will be even deeper in the money. So here we sold the 70 strike, as you can see. Let's go ahead and, for example, buy the 73 strike. So here we will have to put money out of our pocket. This is why the price is now reduced. We will still have IV crush on both of them, but as you can see, the structure here now is sort of more protected, because while we are also short a call, we have this protective long call on our side that basically covers the worst case scenario. And so the numbers of break even, P&L, etc. don't change that much, given that it's basically the same structure. However, what we will notice is that now our loss is capped, meaning that whatever happens, whatever big the stock move is, our loss will not go above a certain value. And so here we see that for a 15% move, the P&L is around minus 400%. And basically, as we go higher and as the stock moves higher, the P&L stays at that value of minus 14%, as you can see. Still a huge value, completely agree. And so this is where calibration, etc. comes into play to find a break even and a P&L, a max loss that you're happy with. But here we see right away how we basically covered against these big moves, right? This is the first step. And while we're at it, this is actually a good milestone, a good step into volatility strategies around earnings, where basically, as you know, there is another way of playing earnings where we abstract subtract from the direction aspect of it, because here notice that basically we are still directional. Here we are selling these calls and buying these deeper basically calls, and so still betting on that the direction basically we want it to be downward, or if it's upward should not beat this 3.3. Now what we can do is go actually a step further, and now actually protect against even the other symmetrical aspect, and do the same thing on the put side. So the same way that we sold this call and bought back a deeper call, let's actually go ahead and same here. Let's for example compose a short put, and so here we will try to have what we call a delta neutral position. And so for example go ahead and compose a put that would be with a closed delta or opposite delta to the 70 call. Here roughly let's go ahead and select the 65, basically selling the 65 for this closest expiration, and same symmetrically as we did with the calls, basically cover by buying back or buying the 62 call. So again reducing, basically this is money we have to put, reducing our entry cost. And now let's notice this new position where it is basically the symmetrical in both ways of what we composed for just the call side. So here our break even, notice, is now basically symmetrical, where with the upward move and downward moves being protective, minus 5.7 on the downward side, plus 4 on the upward side. And so what we did here is basically betting that the stock move will stay within this range at the end of the day. Notice how this simulation of the PNL going through the week with no stock move for the upcoming earnings result in the same. The position, the whole position basically will collapse from this premium that we sold for of $1.12 to basically 1 cent by Thursday, again in the best case scenario of no stock move. And in the bad scenarios of moves that are actually above this level, the idea is that we are protected against these unlimited losses that we saw with just one short call. And so for example, as you can see here, our loss will not be higher than this minus 180, and so whatever happens for this $1.12 per contract, we will have to put basically $2 extra to buy back the position. And this again is symmetrical, so even in the same, if the downward move happens on the other side, same, we will be also protected, because it makes sense, as for each side the long leg will compensate for the short one basically. And here we arrive at a position that we call basically an inverse condor, that is composed of, as you can see, a short strangle. This is what we call a strangle, a call and a put out of the money, but also a long, deeper strangle, even wider strangle with wider legs, to basically protect against these moves. And so you see gradually what we did here during this video is basically step by step construct what we new strategies around earnings, where we're not just selling covered calls or cash secure puts going into earnings. We can actually, with one step further research and one step more of calibration, go into this position where we are contained and sort of betting on the slow implied move, low move on the day of earnings, and so trying to profit from this IV crush while still being protected. And this is what we call short volatility around earnings, that we always recommend to have these type of capped positions. Never go with short straddles, short strangles. The benefit of them really doesn't outweigh the risk, these huge risks that we've seen of unlimited losses. And so, as you can see, the further step to do in doing this calibration is that obviously we want to know, well, how likely is this range of plus minus 5% here, 4% for Walmart moves. And this is where, as you know, studying the past moves comes in hand. And so the idea of actually researching and seeing these range of moves, this outlier presence, quickly here we see that it looks like it could be a good move to do this on Walmart, because as you can see, the past moves on earnings are somewhat contained. The average here is around 4%, so pretty close to our break even. And historically, this is not a stock that have seen many outsized moves, these outliers and big moves that can make our position go to max loss. Still, we would be ready for those moves and those bad case scenario, worst case scenarios, by going with these symmetric and non-directional, so capped positions like inverse condors, butterflies, etc. And always keep in mind to calibrate with a range of moves that's high enough. Here what we're doing is really we're playing the numbers basically, that 70% of the time, 75% of the time, Walmart does not exceed this range of move. So as you can expect, playing this type of trades, whether it's for Walmart or any other stock, time after time, basically the numbers will play on our favor, and we would see that 75% of our trades on this setup will be profitable. But the idea is really not to wreck our accounts, and so always basically cap positions and look for, as we always do, favorable risk rewards. The risk has to outweigh the reward, and let the statistic play in our favor. Thank you for watching, hope this was helpful, and see you in the next video.